Hello all, welcome to the channel. So let us today talk about the much talked about topic in the field of finance, that is what is the difference between cash flow and fund flow. Before that, we should know what is the definition of cash and fund. So let's discuss. As per India's 7, cash comprises cash on hand and demand deposit, whereas cash equivalent is a short-term highly liquid investment which can be readily converted into cash and does not carry any significant risk of change in its value, which may be converted into cash for a period of say 3 months from the date of acquisition. So this definition is provided through Index itself. Fund, on the other hand, in commercial parlance, fund means working capital. The other definition is a reserve which is created by earmarking money for a specific purpose or investment. Say investment fund is there, means the fund has been created, carved out of your profit, and it will be used for further investment, say investment FD, mutual fund and all. So that will be your investment fund. So that is another one of the definition of fund. Let's know about the difference through a apt example. In company ABC Limited, a transaction happened, and in the transaction purchases were made for rupees 5 lakh, of which credit purchase were rupees 3 lakh. 80% of the purchased goods were sold, and sale amount was 4,50,000. Credit sale was 350. Cash expense was 40,000. So let us calculate cash flow from operating activities in this example. As per Ind AS 7, you may be knowing that cash flow from operations can be calculated through two methods, that is direct and indirect method. Direct method is nothing but more of an cash account if you prepare receipt and payment account. So in this transaction, you know cash sale is 1 lakh, because 350 was credit sale and 450 was overall sale, means cash sale was 1 lakh. On the other hand, cash purchase was 2 lakh. 5 minus 3 means 2 lakh. Cash expense is given as 40,000, so your answer will be 1,40,000. Now using the indirect method, first we need to know the profit in this transaction. So purchase of 5 lakh is given, cash expense of 40,000, sales of 4,50,000, and closing stake of 1 lakh. You know the P&L is prepared through accrual, following the accrual method and matching concept. That's why matching concept, closing stock is there, and accrual is there. That's why credit purchase and credit sales have been there in the account. That's why, since these accrual and matching concept has been followed in P&L, you need to make some adjustment so that you come to know what will be your actual cash flow from operations. So your profit is rupees 10,000. What we will do now is we will reduce the increase in working capital or increase in current assets. Why it should be done? The logic behind it is, you made a sale of rupees 4,50,000, out of which 3,50,000 was your credit sale, means you have not received that money yet, but in P&L account you have already recognized it as an income. So to be more conservative, or to know the reality of your reality of your business performance, we need to do this adjustment. So we will reduce this debtors or increase in this credit sale through your profit. And the same way, matching concept is not regarded in it. So we already have paid for the stock, so we'll reduce it because this is a cash outflow. And on the other hand, creditors will be added because you have not paid for that creditor for that particular purchase. So your net increase in working capital will be 1,50,000 rupees, and cash flow from operation will be 10,000 minus 1,50,000, that is minus 140. Ind AS 7 says or encourages the organization to report cash flow from operating activities using the direct method, because direct method is more simple. It gives a comprehensive picture of the transaction. Sometimes indirect method may be very vague, because we may not know that what actual cash sale or cash purchase has happened, whereas this is very clear cut picture giver, the direct method. Now let's talk about the fund from operation in this particular transactions. The funds, by definition, fund is profit plus non-cash expense, that is depreciation, amortization, minus plus non-core income or expense like profit on sale of property, interest income, because they are not operating activities, they are non-core activities. They may be investing or financing activities, so that's why we will not be recording them. So in the given example, fund from operation will be profit itself. So you know the fund is working capital. It regards the cash as well as working capital. So that's why even though you have made a credit sale of 350 or 450 overall sale, so it has considered overall sale of 450. So the difference between the final difference, if you come to know, the conclusion will be cash flow from operation will be fund from operations minus increase in working capital and plus decrease in working capital. And the idea is cash flow disregards accrual concept and matching concept, whereas fund flow doesn't do so.